Welcome to the deep dive. We're here to pull out those key insights that really give you an edge.
Yeah, the stuff that makes you think.
Exactly. And today we're digging into the financial world of a giant, Warren Buffett, you know, the Oracle of Omaha.
His success is legendary, obviously. Yeah, but how did he get there? What were those core skills?
That's what we want to unpack for you. We've looked at, well, the key moments across his life, his career, trying to find those nuggets, those actionable lessons.
Maybe some surprising bits along the way.
Hopefully. So we'll walk you through 7 phases, looking for the signs of his financial know-how, what benefits he got, how he actually used these skills.
Right, and the world he was operating in, the competition, the landscape.
And the big takeaways for entrepreneurs, or really anyone interested in finance. Okay, ready to jump in.
Let's do it. It's fascinating just how early this all started for him.
Right, it wasn't like a switch flipped later on.
No, not at all. The groundwork, the entrepreneurial seeds were there from childhood, really young.
Okay, so section 1, the entrepreneurial seeds and early investing. This covers, what, his childhood up to his early 20s?
Yeah, that period. And even then, it's pretty clear he had a knack for making and managing money way beyond his age.
It wasn't just kid stuff.
Definitely not. I mean, these were real signs of financial literacy budding. He was out there earning, right? Selling chewing gum, Coke, magazines, actually running little businesses.
And the stock market thing at 11, buying for himself and his sister.
Exactly. And then, get this, filing a tax return at 13 and claiming his bike as a business expense for his paper route.
Wow, okay.
That shows a level of understanding of the system that's just, well, unusual for that age.
And it paid off, didn't it? There were real benefits.
Oh, for sure. He started building up capital really early.
Yeah.
That gave him a head start. Plus, he learned lessons, like regretting selling a stock too soon. A classic mistake. But he learned it early with smaller stakes.
Right, better than later with millions.
Precisely. And he was just getting that practical feel for earning, spending, taxes, the whole cycle.
So how did he apply this? You see him putting these lessons to work right away?
Yeah, you do. He wasn't just hoarding the cash. He was reinvesting. Buying more pinball machines for that little arcade venture he had.
Ah, okay. Expanding the business.
And then buying actual farmland with his earnings. At 14, he understood owning assets that generate income.
That's incredible.
And that lesson about holding investments, being patient, that really became a core part of his whole philosophy later on. The seeds were planted then.
Thinking about that time, who were his competitors? It feels different than, say, Wall Street.
Oh, totally different. Back then, it was probably, other kids in the neighborhood doing similar things, maybe trying to sell to the same people.
Local hustle.
Yeah, local hustle. And just understanding the basic dynamics. What do people want? What will they pay? Very micro-level stuff.
So if you're an entrepreneur listening, what are the big takeaways from this early phase? What really jumps out?
I'd say 3 things. 1, start early, be ambitious. He aimed to be a millionaire by 30, which was a huge goal then.
Yeah.
2, learn by doing. That hands-on experience is invaluable. You just can't get it from a book.
Sure.
And 3, track your money from day one. Income, expenses, get that discipline early. It's foundational.
Okay, let's move to section 2. Formal education and the birth of value investing. Columbia. Benjamin Graham. This feels like a real turning point.
Huge turning point. And a sign of his growing sophistication was that he chose to go learn from the best, from Graham.
He didn't just rely on his gut feelings from the early days.
Exactly. He sought out the structured knowledge, the expert guidance, and he really absorbed fundamental analysis, digging deep into a company's actual worth.
Not just the ticker symbol.
Right, which led him straight to value investing.
Yeah.
Graham's whole philosophy of buying good companies when they're cheap, when the market undervalues them, finding those bargains.
What were the main benefits of that formal learning and having Graham as a mentor?
Well, it gave him a really solid theoretical toolkit. Understanding concepts like discounted cash flow, how to value future earnings today, or relative valuation, comparing companies.
So a framework.
A disciplined framework, yeah, based on intrinsic value, not just market noise. And that really set him up for success in his early investment career.
How did he actually put it into practice beyond the classroom?
He was all in. He soaked up everything from Graham at Columbia. Then he deliberately went to work for companies connected to Graham, like Jayco.
Ah, reinforcing the learning.
Yeah.
Yeah.
And then the big step, starting the Buffett partnership. That was his vehicle to really implement these value principles with his own money and investors' money.
Who was he up against then in that investment world? What were the competing ideas?
Well, there were other investment firms, obviously, but he was also kind of competing against the prevailing Wall Street trends, more speculation, momentum
The
trading.
hot stocks approach.
Exactly. Some people even thought Graham's value approach was too conservative, too slow, so he had to have conviction against that current.
So for entrepreneurs today, what's the lesson from this phase of seeking out expertise?
Find mentors. Learn from the experts in your field. It's incredibly valuable.
Don't try to reinvent the wheel entirely.
Right, and build a really solid understanding of your industry's fundamentals. Know what drives value.
And focus on that underlying value, not just the latest trend.
Absolutely. Don't get swept up in the hype. Stick to the fundamentals.
Okay, section 3. Transforming Berkshire Hathaway. This is where things get really interesting. Moving beyond stocks to actually reshaping a company.
Yeah, this really showcases his skill in capital allocation, which is a huge part of his genius, really.
Seeing potential beyond the original business.
Exactly. He saw that the textile mill, Berkshire's original business, was struggling long-term. Big insight.
Instead of just trying to fix it.
He pivoted. He used the capital from it to buy other, better businesses, building this diverse conglomerate. Think See's Candy's strong brand, consistent cash flow. Smart acquisition.
And the benefits of that strategy, pretty huge, I imagine.
Oh, massive. It created this platform for diverse, long-term holdings. Reduced risk, not having all eggs in one basket.
Diversification.
Right. And he showed he could make money not just picking stocks, but by buying whole businesses, sometimes improving them, and letting them grow. It really built the foundation for Berkshire's incredible wealth creation machine.
How did he actually do it? How did Berkshire go from textiles to this holding company giant?
Well, he cleverly used the cash flow, especially from the insurance side of the business later on.
Ah, the float.
Exactly, the float. He used that relatively low-cost capital to buy other businesses that met his criteria. Good management, good long-term prospects, fair price.
Still applying value principles, but to whole companies.
Absolutely. And the holding company structure itself was brilliant. It allowed decentralized operations, but centralized decisions about where to put the money.
Smart structure.
Yeah.
Who was the competition then in the corporate world as he was building this?
He was competing against other conglomerates, other holding companies looking for similar deals.
Bidding wars.
Potentially, yeah.
Yeah.
And of course, the companies Berkshire bought still had to compete in their own industries. So competition on multiple levels.
What can today's entrepreneurs learn from this Berkshire transformation phase, especially if they want to scale or diversify?
First, be honest about your business model. Be willing to pivot if the future looks dim or better opportunities appear.
Don't be sentimental.
Right. Second, really master capital allocation. Knowing where to reinvest your profits is critical for growth.
You're making your money work for you.
Exactly. And third, always keep an eye out for strategic acquisitions that fit your vision and can add real value.
Okay, shifting gears slightly. Section 4, mastering communication and building trust. Buffett's known for being incredibly clear, right?
Oh, absolutely. It's a huge part of his success and maybe sometimes overlooked. His ability to take complex financial ideas and just explain them simply.
Yeah, in plain English.
And he's so open about things. He talks about mistakes, failures, not just the wins. That builds incredible trust.
He uses stories too, doesn't he?
Yes. Makes complex business concepts relatable, memorable, very effective.
What have been the big benefits of communicating like that?
Immense trust and respect from shareholders, from the public. People listen to him because they feel he's being straight with them.
Makes them more receptive.
Definitely. And he himself said good communication skills can boost your value by like 50%. It's a real asset.
How does he apply this consistently? What are the mechanisms?
The annual letters are the prime example. People read them religiously. They're clear, honest, insightful, often funny.
They're famous.
Right. And in public, interviews, Q&As, he speaks directly, avoids jargon. He aims to be understood.
And admitting mistakes. That's pretty rare.
Very rare at that level.
Yeah.
But it builds huge credibility. It shows authenticity.
Who's the contrast here? What does bad corporate communication look like?
Well, you see, leaders buried in jargon, technical terms nobody understands.
Obfuscation.
Yeah. Or companies that spin everything, sugarcoat bad news. Or just dump dense reports without explaining what they actually mean. That erodes trust.
So for entrepreneurs building a company, needing to talk to investors, customers, employees, what's the lesson from Buffett?
Invest time in getting better at communicating. Seriously.
Practice makes perfect.
For sure. And be authentic. Be transparent. Be honest, even when it's tough. Explain things simply. People appreciate clarity, and it builds that crucial trust.
All right, section 5, strategic risk management and long-term focus. His approach to risk seems different.
It is.
Mhm.
It's deeply tied to understanding. His famous line, risk comes from not knowing what you're doing.
So knowledge reduces risk.
Basically, yes. And that feeds into his incredibly long-term view. He's thinking 10, 20, 50 years out, not next quarter.
Which must lead to a different kind of risk-taking.
A very disciplined kind. He avoids stuff he doesn't understand. He avoids unnecessary complexity or leverage. It's calculated, patient.
What are the benefits of that approach? Staying power.
Absolutely. It helps him avoid knee-jerk reactions to market swings.
Hmm.
No chasing fads.
Hmm.
It's fundamental to Berkshire's steady, sustainable success. He makes fewer big bets, but they're usually well thought out and pay off over time.
Can you give some examples of this in action?
Using the insurance float we mentioned, that's a low-risk source of long-term investment capital.
Right.
Refusing to jump into, say, the dot-com boom because he felt he didn't understand those businesses well enough. That took discipline.
He missed some gains, but avoided the crash.
Exactly. And just staying calm during market downturns, seeing them as opportunities, not disasters, that's long-term thinking controlling short-term fear.
Who represents the opposite approach to risk?
You see investors obsessed with short-term profits, maybe day trading, or using lots of leverage.
High risk, high reward. Sometimes.
Sometimes. But also high risk of ruin. And anyone driven purely by emotion, fear when the market drops, greed when it rises, they're not following Buffett's playbook.
What should entrepreneurs take away from this about risk and long-term vision?
Know your business inside and out. That's your best risk mitigation.
Deep knowledge.
Deep knowledge. Cultivate patience. Cultivate discipline. Don't get panicked by short-term noise. Keep your eye on the long-term prize.
Makes sense. Okay, section 6, commitment to continuous learning. The reading habit is legendary.
It really is. 5 or 6 hours a day, apparently. That alone tells you something.
And not just stock reports.
No, very broad. Business, history, human behavior, tech. He reads widely. He sees learning as the best investment he can possibly make.
What does he gain from all that reading? How does it benefit him?
It gives him this incredible breadth of understanding. Industries, the economy, people. That feeds into better decisions.
Connects the dots.
Yeah, exactly. It constantly sharpens his thinking, his analysis, and helps him refine his strategies as the world changes.
How does he actually apply it? I mean, beyond just accumulating facts.
Well, he devours company reports, obviously. Industry analysis, news. He learns from history what worked, what didn't for others.
Learning from mistakes, even other people's.
Right. And he encourages that learning culture within Berkshire, too.
Who's the opposite of this? Who isn't doing the learning?
Well, investors who don't do their own homework just rely on tips or headlines.
Surface level.
Yeah. Or maybe business folks who get stuck in their own little silo, don't look outside their specific area. A narrow view.
So the lesson for entrepreneurs here seems pretty clear.
Make learning a core habit. Read. Read widely.
Not just stuff about your industry.
No, broader is often better. Use reading to get deep knowledge. And remember, knowledge compounds. Just like money, it builds over time.
Great point. Okay, last section, section 7, ethical leadership, philanthropy, and enduring legacy. This feels like it ties everything together.
It really does. His financial journey isn't separate from his ethics. Integrity is central.
How does that show up as a financial skill, though?
Well, he prioritizes integrity in who he works with, who he invests in. He tries to align investments with value.
Ethical investing to some extent.
You can say that. And of course, his massive commitment to philanthropy, giving away the wealth, that's a decision rooted in his values about the purpose of money.
And what are the benefits of operating with that strong ethical core?
It builds incredibly strong relationships. Trust is everything in business, right?
Absolutely.
It earns him huge admiration, respect. And ultimately, it lets him have this massive positive impact through giving back. That's a different kind of return on investment.
Can you point to examples where this ethical stance was really tested or demonstrated?
He always talks about looking for management with integrity. Intelligence and energy aren't enough without it.
The integrity filter.
Yeah. His handling of the Salomon Brothers scandal back in the day showed real principle under pressure. And the giving pledge, committing his fortune, that's a huge public demonstration of his values.
Who represents the contrast here in terms of ethics?
Sadly, you see examples of people or companies cutting corners, prioritizing profit over principle, misleading practices, lack of transparency, leaders who don't seem to value integrity.
So the final lesson for entrepreneurs, What's the takeaway on ethics and legacy?
Integrity isn't optional. It's fundamental for long-term success and reputation.
Build on trust.
Build everything on trust. And think beyond just profits. Consider your impact. How can your success contribute something positive to the world?
So wrapping this all up, Buffett's financial literacy, it's clearly way more than just being good with numbers or picking stocks.
No, absolutely. It's this whole package.
Yeah.
A disciplined mindset, nonstop learning, clear communication, strategic thinking, patience, and that unwavering integrity.
Applied consistently over decades.
For decades, that's the key.
And for you listening, these aren't just principles for billionaires. They're foundational ideas for building lasting financial well-being, whatever your goals are.
Which brings us to a final thought for you to chew on. We've covered these 7 areas of Buffett's financial skills, from those early hustles to his ethical leadership. Which one of those skills really resonates with you right now? Which one do you think could make the biggest difference for you in your work, your finances, or just how you understand things?
And maybe think about one small thing, just one concrete step you could actually take, maybe even today, to start cultivating that particular skill in your own life. Welcome to the Deep Dive. We're here to pull out those key insights that really give you an edge.
Yeah, the stuff that makes you think.
Exactly. And today we're digging into the financial world of a giant, Warren Buffett, the Oracle of Omaha.
His success is legendary, obviously. Yeah, but how did he get there? What were those core skills?
That's what we want to unpack for you. We've looked at, well, the key moments across his life, his career, trying to find those nuggets, those actionable lessons.
Maybe some surprising bits along the way.
Hopefully. So we'll walk you through 7 phases, looking for the signs of his financial know-how, what benefits he got, how he actually used these skills.
Right, and the world he was operating in, the competition, the landscape.
And the big takeaways for entrepreneurs, or really anyone interested in finance.